Our classroom stock portfolio of high-yield, dividend-paying companies now has an annual return of 28.22%, and it's beating the S&P 500 since the portfolio started. And our Dividend-Growth stock portfolio, which was started 20 months earlier, has an annual return of 20.86%. But our best performing portfolio so far has been our technology portfolio, which has an annualized return of 59.55%. It has only been in existence since April of this year, so its return will likely fluctuate a lot, and it's very volatile. Later in the video, I'll discuss ways to potentially boost the return of our stock portfolios, but it will require giving up some portfolio diversification. So this week, the market fell, but Broadcom, which is in 3 of our portfolios, saw its stock rise over 25% last week alone, and it announced its second dividend increase this year. The stock has raised its dividend for 14 straight years. Besides the large companies in the S&P 500 falling last week, mid-cap stocks did worse, falling over 1.5%, while small caps fell almost 3%. Now, this is just last week alone. Hopefully, we'll be seeing some better bargains next week with the lower stock prices. And it's healthy for the stock market to take a breather after being up so much. Now, this upcoming week on Wednesday, the FOMC will announce if they will indeed cut interest rates 0.25%, which is a general consensus. I expect that to happen, but if not, the market could react negatively as the interest rate cut already seems to be baked into stock prices. So, what is this slide showing? It's showing the portfolio value over time for our main portfolio, the one we started first, which invests almost exclusively in dividend-growth stocks. As a class project in 2022, we started investing $12.50 each week into the portfolio, and it's now worth over $2,714 after 154 weeks. Each week, we take that deposit and split it up to buy 10 different dividend-paying stocks. So we are buying fractional shares of stock. Each week, we re-rate the stocks, so the list of stocks fluctuates from week to week. And in August of last year, we started a second portfolio, this time investing in high-yield dividend-paying stocks. Now, the tan line on this graph shows what the portfolio value would be if we had instead put the money into a savings account. Now, in our first year, 2022, stocks and bonds did not do well, and as you can see, our portfolio had overall losses where the blue line, right here and here, dipped below the tan savings account line. But the power of compounding is working in our favor as the portfolio really took off in November of 2023. I'll also update our tech stock portfolio later in the video, which has only existed since April of last year, which I mentioned already, but has been the best performing portfolio over time. And I can't emphasize this enough. Tech stocks are very volatile. You'll have really great weeks, which we had 2 weeks of great weeks, and then some weeks will be really bad. And for those who have been asking, I put the dividend growth stock portfolio and the high yield stock portfolio on our website, which is beatthestockmarket.com. Hi, Professor Rex here. If you're new to my channel, I teach college accounting, and I often show my students how to use the accounting concepts that I teach to pick stocks because it gets the attention of my students and keeps them engaged. To show them accounting concepts in action, starting in 2022, we started a class project in which each Monday I invest actual real-world money, $12.50 per week, which is roughly the equivalent of $50 a month, into 10 different dividend-paying stocks. And because those original students are no longer in my class, I decided to make this video series to let them know how our portfolio is doing. Also, viewers can use our progress as inspiration for their savings goals and get ideas of company names that they can do their own research on. There are timestamp links in the description of the video in case you just want to jump to the list of stocks we bought last week, or our list of best performers or any other section of the video. In 2022, the year we started the dividend growth portfolio, the market did not perform well, but because I don't believe in trying to time the market, we kept buying each week at what turned out to be great prices. When at the time, some people were panicking, so always be a long-term investor. Then in 2023, stocks took off. Currently, the portfolio's value is over $2,714. The portfolio's return has been 20.86% per year. Last year, the portfolio's return was 28.6%, which beat the S&P 500. And in the preceding year, the portfolio once again beat the market. Before we get into which stocks we bought this week, a lot of people have been asking me for my favorite books about investing. My 2 favorite books were the basis for the 3 stock screens I publish monthly on our website, which you can see on this slide. My favorite investment book is called What Works on Wall Street by Jim O'Shaughnessy, whose investment firm managed over $6.4 billion of investments when he retired. The book is the basis of 2 of the 3 stock screens I publish on our website, beatthestockmarket.com. They are the trending value stock screen, so if you're a value investor, you might be interested in that, and the consumer staple stock screens. Consumer staple stocks tend to be very low volatility and very conservative stocks. I update the stock screens monthly. So what is a stock screen? It is a set of criteria used to narrow down a large list of stocks to a much smaller list of stocks in which you can invest in or do further analysis of them. The book examines various ways to tell if a stock is undervalued by examining simple metrics like the price to earnings ratio, also called the PE ratio, dividend yield, etc., as well as combinations of those simple metrics. There are a lot of tables and graphs in the book, so if you're a numbers geek like me, you will probably like it. It also talks about the history of the stock market and the psychology of investing, which is also fascinating. The other book I recommend, especially for younger investors, was written by the son of the author I just mentioned. It's called Millennial Money and is the basis for the Millennial Money stock screen that we publish monthly on our website. Of course, you can follow the book and just recreate the screens on your own to save yourself some money. It's a much shorter book than What Works on Wall Street. I've got 2 links in the description of the video to the books in case you want to check them out. Also, see if your library has them and you could save yourself some money. Since we are now in the month of December, let's take a look at the historical stock performance in the month, and I updated some stuff this week on this slide. According to the Center for Financial Research and Analysis, December sees the largest average stock gain of all the months of the year since World War II. It also has the highest percentage of gains of all the months of the year. And it also has the lowest volatility of all the months, with nearly 40% less volatility. And then there is a Santa Claus rally. According to Investopedia, the founder of the Stock Traders Almanac coined the Santa Claus rally in 1972. So what is that? He defined the time frame of the Santa Claus rally as the final 5 trading days of the year and the first 2 trading days of the following year as the dates of the rally. The Stock Traders Almanac compiled data during the 73 years from 1950 through 2022 and showed that a Santa Claus rally occurred 58 times, or roughly 80% of the time. That means stocks went up during that short time period. So basically, December is historically the best month of the year for stocks. Theories that explain a Santa Claus rally include the end-of-year tax considerations, a general feeling of optimism and seasonal happiness on Wall Street, and Wall Street investing their holiday bonuses. And trust me, Wall Street guys get huge bonuses. Some institutional investors settle their books and vacation during this time of year, leaving the market to retail investors who tend to be more bullish toward the market. Now, the Center for Financial Research and Analysis also had a list of the best performing sub-industries in the month of December since 1990, and they are home building, healthcare products, building products, home improvement retail like Home Depot, hotels, resorts, and cruise lines. Now let's talk about the formula used to calculate portfolio performance. Because we are investing additional funds each week into most of our model portfolios, the way to calculate portfolio performance becomes more complicated. The formula that is most commonly used to calculate portfolio performance is called XIRR, also called Extended Internal Rate of Return, and we use it too. It's the same formula used to calculate portfolio performance in Quicken, the most popular personal finance software. You can see the formula at the bottom of the screen. Now you can calculate by hand, but if you want to maintain your sanity, you are better off using Excel to calculate it for you. And then use Quicken software to double check it if you want to be sure, which is what we do. In this video, we talk a lot about our dividend growth portfolio and our newer high yield portfolio, which is geared more towards those nearing retirement. The table at the bottom of this slide shows a portfolio comparison when both portfolios existed. The high yield portfolio was started in August of 2023, and the annualized return so far is 28.22%, which is surprisingly higher than our dividend growth portfolio, which has an annualized return of 22.5% over the same time period, and includes the dividend growth portfolio includes way more growth stocks than the high yield portfolio. I would expect that the dividend growth portfolio would have the higher return over the long run especially since the high yield portfolio has less than 0.5% in tech stocks. Last week, I believe, we bought our first tech stock for the high yield stock portfolio. But time will tell which one will do better. If an investor was solely investing in the high yield portfolio, I would think about supplementing it with some tech stocks for additional diversification. On our website, we have ideas for technology-focused investments that provide income ranging from dividend growth stocks to closed-end funds and ETFs. Now remember, the high yield portfolio has only existed for nearly 16 months, so its annual return will likely jump up or down to a greater extent than our dividend growth portfolio's return, which has been in existence for 20 more months than the high yield portfolio. The fact that the high yield portfolio is outperforming our dividend growth portfolio over the same time period is pretty surprising to me, but last week we finally saw the numbers come closer together. Now this slide shows the cumulative growth of the dividends we've received in our dividend growth stock portfolio. Our dividends for the latest month increased 53% over the same month a year ago, and our dividends for the latest quarter increased 130% over the same quarter a year ago. The graph shows how quickly the dividends are growing and is a great example of the power of compound growth. Now, Albert Einstein is widely rumored to have called compound growth the most powerful force in the universe. So why do we only invest in dividend-paying stocks in our two main portfolios? And even in our tech stock portfolio, about 80% of the stocks in there pay dividends. Now, the first reason we stick with dividend-paying stocks for our dividend strategies is, according to a Hartford study, over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.17% per year, but for non-dividend-paying stocks, average return has been much lower at 4.27%. The study is updated each year, so go check out the source link that I included at the bottom of this PowerPoint slide. Morningstar also recently released a report that went all the way back to 1927 and came up with the same conclusion. The conclusion being that dividend-paying stocks have a higher return and less volatility than non-dividend-paying stocks. Now that second point about having less volatility is probably even more important than the fact that dividend-paying stocks have a higher return. So why is a lower amount of volatility so important? Well, it's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you are to panic and sell at the wrong time. So now remember that if you just are going to invest only in tech stocks, which a person could choose to do, but it's going to be a lot more volatile, and you might not have the intestinal fortitude to stick with it. So why are dividend-paying companies less volatile on average? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks as measured by beta and standard deviation tend to be much lower for dividend-paying stocks, and that's a good thing. And finally, the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our Classroom's dividend portfolios only invest in dividend-paying stocks that have increased their dividend recently. Another report. BlackRock recently released a report showing that $10,000 invested in Dividend-Growers. Now, a Dividend-Grower is a company that increases their dividend, which is what we focus on. And in Dividend Initiators, that's a company that starts paying a dividend for the first time. That $10,000 grew to $2.6 million versus $1.6 million for the S&P 500, a difference of 62.5%. Now, that's not the best comparison because S&P 500 also includes some dividend payers. So the better comparison is to non-dividend companies. So that same $10,000 invested into non-dividend paying stocks only grew to $1.2 million. So in other words, stocks that raised their dividends or started paying a dividend beat the stocks that did not pay dividends by 116.7%. Now the holy grail of dividend investing is having a stock portfolio that produces two things. One, a growing stream of income that produces enough cash to cover your expenses, plus extra cash to cover travel, vacations, luxury purchases, etc. And two, also produces a growing stream of income that also grows faster than the rate of inflation. And dividend-paying stocks historically increase their dividends significantly higher than the rate of inflation. That means that quality dividend-paying stocks can provide a growing income stream for a lifetime. Now, this is in contrast to bonds, which do not raise their payments to bondholders. Here are two examples of stocks growing their dividend payouts over the year. The first stock is Broadcom, which just increased its dividend for the second time this year alone and for the 14th consecutive year. Now, I bought Broadcom, a chip maker, in 2020, just 4 years ago, for my taxable account. At the time, its yield was 5.01%, meaning for every $100 I invested in the stock, I would receive $5.01 each and every year. The company has quickly grown the dividend to the point where the yield, based on the original investment, is no longer that 5%. It's already 9.14% just 4 years later. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen so much, and that's why it's important to invest early and be patient. And I fully expect Broadcom to continue to increase its dividend well into the future. Like I said, it's already increased it 14 consecutive years. And if not, that's why we have constructed a diversified portfolio. This is the power of investing in quality dividend growth companies. Now, my second example of a high quality company with a history of raising its dividends is Home Depot. In 2003, when I was attending college, I had started a dividend stock portfolio for the investment newsletter that I had started at the time, and Home Depot was recommended for that portfolio and is still in the portfolio today. At the time, its yield was a low 0.83%, meaning for every $100 I invested in the stock, I would only receive 83 cents a year. Seemingly not much to get excited about. But over the years, Home Depot has grown the dividend to the point where now the yield is, based on the original investment, 31.1%. And like Broadcom, while there are no guarantees, I fully expect Home Depot to continue to grow its dividend well into the future. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen so much. Again, this is why it's important to buy early and be patient. Now remember, stocks historically have a higher return than bonds and are also riskier than bonds, but you certainly will not find a bond that pays anywhere close to the yields on the original investment that these two stocks are paying. And bonds don't increase their payouts to investors like stocks can and often do. Another reason to own dividend-paying stocks is for the potential to generate up to $126,700 of tax-free income each year if you're married and filing jointly. Remember, the ultimate goal of dividend investing is growing your portfolio to a point where it generates enough income each year to live off the dividends. And because companies historically increase their dividends above the rate of inflation, you have the ultimate income stream that not only covers your expenses, but grows over the time. And if you're married and filing jointly, you can make up to $126,700 in qualified dividend income and pay zero federal tax on those dividends if you have no other income. That's perfect for retirees. If you're single, that amount is $63,350. Those amounts usually increase each year as the standard deduction increases and the tax brackets are adjusted. And these numbers were boosted just last month. So how are those amounts calculated? First, you find the 0% tax bracket for long-term capital gain, and then find the standard deduction, which can be located in IRS Publication 505. As you can see, for 2025, the standard deduction increased in November, meaning that you can potentially earn even more tax-free income from qualified dividends than you could in 2024. Then the final step is to take the 0% capital gains amount and add it to the standard deduction, which means we get a final amount of $126,700 that a married couple filing jointly could generate an income from qualified dividends that would be federally tax-free. So why did we choose to start investing in our model stock portfolio with only $12.50 per week, which is essentially the same as $25 per paycheck? Now, I personally am investing a lot more than that in these dividend strategies, but for our classroom model portfolios, the main reason we started with a low weekly investment amount is because I want to show my accounting students that you don't need much to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week. And because my brokerage account, Fidelity, allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with little money. Now, when I started the Dividend-Growth portfolio, originally I invested $25 per paycheck, but found the process to be so fun that I split it up and now invest $12.50 every week. And we boost the contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation. So when you get a pay raise, you should also invest more too. By the way, I also invest in these same stocks in my retirement account and my taxable brokerage account. The research we discuss in class is the same research I use for myself. Another reason I started with a low investment amount was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assumed the contributions would increase by 3% each year, which is around the historical rate of inflation. That means in the second year, it's assumed that the person invested an additional 35 cents each week for a total of $12.09 per week instead of the original $11.74. For our classroom dividend growth stock portfolio, in year 2, we boosted the weekly investment 82 cents for a total of $13.32 per week because inflation was high that year. In year 3, inflation wasn't as high, so we boosted the weekly investment by only 49 cents for a total of $13.81 per week. Now, a very popular exchange-traded fund, also called ETF, that only holds dividend stocks is called the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. Everyone calls it SCHD because the name is kind of long. So SCHD is a large holding in my personal account. So I've been tracking SCHD's performance closely with our 2 dividend-paying stock portfolios. As of today, our Dividend-Growth classroom stock portfolio's annual return is 20.86%. If we'd instead invested the same exact amounts into SCHD on the same days, the portfolio's return would only be 10.42%, a difference of 100.2%. Our high yield portfolio is also outperforming SCHD, but by an even larger amount. Now, SCHD pays a dividend next week, so their return will boost a little bit. Obviously, there's no guarantee that our portfolio will keep outperforming SCHD at such a high rate, but I've been gradually selling off my personal SCHD holdings and reinvesting in our 2 dividend-paying stock portfolios as well as the tech stock portfolio. This slide shows our best performing stocks based on when they were initially purchased. This includes all 4 of our portfolios, but as you can see in the upper right corner, the dividend growth stock portfolio was started much earlier than the other portfolios, which means the stocks in the portfolio have had much more time to see their prices rise. Therefore, this list of best performing stocks thus far will be dominated by our dividend growth stock portfolio, at least for the time being. For example, our tech stock portfolio has been our best performing portfolio on an annual basis so far, but because it has only existed since April of this year, it only has one of that portfolio stocks in this list so far, and with that being Shopify at number 12, with a 95.7% return in a little over 6 months. Of our 2 dividend portfolios, our best performing portfolio thus far on a per year basis is the high yield portfolio. But it only has one stock on the list so far, that being Tapestry at number 14, because the portfolio was started 20 months after the dividend growth portfolio. It also holds far fewer stocks than our dividend growth portfolio. Stocks in yellow. Oh, I screwed up. Broadcom is in yellow. No, I've not sold Broadcom. Dang it. Anyway, we sold the stocks in yellow other than Broadcom. The one that should be in yellow instead is Evercore. So Evercore we sold. Broadcom is still in the portfolio. Thank goodness. We sold Crane Holdings, F&G Annuities, and ReposiTrak. Those 3 were under the radar dividend payers. And we also sold Tapestry. So our best performing stock so far has been Broadcom. So far it's provided our dividend growth portfolio with a 302.7% return in less than 3 years. It was also purchased later for our tech-themed portfolio, which is now, let's see here, number 6 on the list at 108.9% in a little bit less than a year. Evercore, number 2, which we sold, this should be in yellow like I said before, has a return the second most with a 252.9% total return in a little bit over 2 years. Broadcom and Evercore have total returns over 200%, which means the initial investment has tripled. In fact, Broadcom has quadrupled. So far, 9 stocks have doubled, tripled, or quadrupled their initial investment, with a ReposiTrak, Goldman Sachs, and Shopify barely missing that doubling mark. And let's see, the fastest risers that are still in our portfolios are NVIDIA in our technology-themed portfolio with a total return of 178.9%, in less than 12 months. Shopify, which has almost doubled in 6 months, and Bank of New York Mellon with a 92.7% return in less than 15 months. And remember that total return includes both the dividends the company has paid as well as the increase in the stock price. All these stocks pay dividends except for Shopify, which is in our tech stock portfolio. As I mentioned before, our tech stock portfolio contains about 80% dividend payers, but Shopify is one of them that does not pay a dividend. So here is a usual disclaimer. This presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others, but you always need to do your own research, also called your own due diligence. So we only sold one stock last Monday, and that was for our high yield stock portfolio. We sold Kinder Morgan, ticker symbol KMI, for an average total return of 63.6% for our multiple purchases. While the stock appears to be fairly valued, the stock's four-way rating, which means valuation, quality, past dividend growth and current yield, and future dividend growth potential, is now in the bottom 24% of stocks, limiting its upside potential. So we sold Kinder Morgan. Now let's talk about the dividend growth stocks we bought last Monday. Here are my ratings for the top 15 dividend-paying stocks this past week. I should say our dividend growth stocks. But we only buy the top 10. We purchased the first 10 stocks on the list that are not in the yellow highlight. Stocks in yellow, last week only being Microsoft, have already grown to be 4% or more of the portfolio. So we do not invest more in a stock if it's more than 4% of the dividend growth portfolio. Thermo Fisher and Lam Research both remained at the top. Now, earnings season, which is when the quarterly event where stocks tend to release their quarterly results, like balance sheet and statement of cash flows and income statement, that's pretty much over until about halfway through January. So our list from week to week will start to appear. It won't shuffle as much as it has been recently, which was during earnings season. Now remember, we use many criteria to filter stocks. And if a stock is hovering around a required level, the stock can make the list one week and then drop off the list totally based on a small movement in that metric. Examples of criteria used to filter out stocks include required margin of safety. It's a Warren Buffett thing. And consensus earnings growth estimates over the next 12 months, which changes frequently. Now, for consensus earnings growth estimates, I will only purchase a stock if its earnings are forecast to grow at least 5% over the next 12 months. That's because we want to invest in stocks that can continue to increase our dividends. So a stock might have a 5.2% estimate one week and make the list, but the next week its estimate could dip to 4.9%, which means that the stock suddenly doesn't make the list at all. This is just one of the many filtering criteria we use to narrow down our list of investable stocks. And as I said before, each week we buy 10 stocks. And since we're investing such a small amount each week, it means we're buying fractional shares in our Fidelity brokerage account. For those that have asked, we do not automatically reinvest dividends into the same stock from which the dividend was paid. Instead, each week when we're buying the 10 stocks as shown on this slide, we combine the weekly deposit with the dividends that have been paid that week and are sitting in the account as cash. We then take that combined total and split it amongst the 10 stocks we are purchasing that week. In other words, we reinvest dividends weekly into the 10 stocks that we're purchasing that week. Now, for the sake of convenience, there's nothing wrong with simply turning on your broker's auto reinvest feature, but we think it's more ideal to invest in our top stocks each week instead of potentially reinvesting in a stock that is fairly valued as opposed to undervalued. Now, the table on this slide includes the company's sub-industry, how undervalued they are according to our research, their risk rating, quality grade, and dividend yield. The most undervalued stocks last week appear to be Huntington Ingalls, Monolithic Power, and Microchip. Remember, all these stocks pay a dividend and have recently increased their dividends, and our methodology used here indicates they're likely to continue to raise dividends. Therefore, this is a dividend growth strategy. We did not buy any under-the-radar dividend payers last week, but there is a possibility we will buy 2 in this upcoming week, so stay tuned. Now remember, this dividend growth stock portfolio is in a brokerage account separate from my regular brokerage accounts to make tracking this portfolio easier. So in my other brokerage accounts, I'm also investing in these dividend growth stocks and the high yield stock in the next few slides and the tech stock portfolio, which is later in the video. This week I purchased over $3,000 of the stocks from those three portfolios as I reinvest dividends and gradually transfer out of my main dividend ETF, that being SCHD, and buy these stocks instead. I'm also trying to tweak the buying strategy a bit to see if I can boost returns. I'll share the results with you once I have enough data. On this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 90% or so of our purchases. The other 10% so far have been invested in smaller, usually smaller, under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they usually are smaller, but studies have shown these historically beat the market averages by a significant amount. As mentioned earlier, we did not buy any under-the-radar dividend payers last week, but we might buy 2 next week. So all the stocks we bought last week qualify as high quality and are dividend growth stocks, which means they have a history of substantially raising the dividends that they pay to shareholders. So risk is the first quality component, which we mentioned in the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantage the company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices as well as the quality or reliability of the reported profits. And finally, the last quality component is financial health. If you're looking for lower risk stocks, I would suggest looking at West Pharmaceuticals, Nike, Microsoft, and General Dynamics, which is relatively new to our ranking. Now, a lot of people living off their dividends only invest in the very low risk stocks. I don't like that. I like to invest in a wide spectrum of risk, being low risk, high risk, and medium risk. And because this portfolio is so well diversified, we can do that. If you have a concentrated portfolio, you might not want to avoid the higher risk stocks. Now remember that the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. The companies earning the highest financial health ratings last week were Thermo Fisher, Applied Materials, Microsoft, and General Dynamics. Now let's look at the dividend growth grades of the companies. Remember, historically the best performing stocks are those that both pay a dividend and have grown their dividend recently. As you can see under the grade called Grade for Recent Dividend Growth and Current Yield, the stocks with the best combination of dividend growth and a higher yield are Lam Research, KLA-Tencor, Huntington Ingalls, A.O. Smith, Monolithic Power, and Microchip. All those earn an A- or better grade. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's not the way it usually works. Companies that are already paying out higher dividends rarely have the greatest potential for greatest growth in those dividends. In our list, as you can see from the last grade called Dividend Growth Potential, the companies in the best position to increase their dividends substantially are Thermo Fisher, Applied Materials, and West Pharmaceutical. These earned an A- or better grade. The companies with the best combination of recent dividend increases, current yield, and potential of future dividend increases are Thermo Fisher, Lam Research, Applied Materials, and KLA-Tencor. And here are trade confirmations from last Monday for the dividend growth stock portfolio. We took the weekly deposit plus any dividends that had been recently received and then invested the total in the top 10 stocks on our buy list for the week, as long as they don't have a portfolio allocation of 4% or greater like Microsoft. Now let's talk about ways to potentially increase the return of our dividend growth portfolio. For those that are okay with giving up some portfolio diversification, I believe there are 4 potential ways to boost the portfolio's returns. Each week we buy 10 different dividend-paying stocks ranked 1 through 10. Now on average, the stocks in positions 1 through 5 outperform the stocks in positions 6 through 10. Therefore, the first way to potentially boost portfolio returns is to buy only stocks in positions 1 through 5 or 1 through 6, however you want to do it. However, the downside is this reduces portfolio diversification. But some investors are comfortable with a more concentrated portfolio. So far, investing in only stocks ranked 1 through 5 would have improved annual returns 56.1%. But I personally prefer a more diversified portfolio since the goal of my dividend portfolio is to live off the dividends. Option number 2, don't limit individual portfolio holdings to 4% of the portfolio's total value. Normally, if a stock's allocation in the dividend growth portfolio is 4% or greater, like Microsoft last week, I won't purchase more of that stock. This technique reduces the portfolio's risk by ensuring the portfolio doesn't become heavily weighted in one or two stocks. I purposely created this portfolio so it would be very well diversified, because the ultimate goal of dividend investing is to have the dividends cover all of your expenses, plus generate extra income for vacations, travel, etc. I'm a conservative investor, and I'm personally investing a lot in these dividend portfolios, so I want to make sure the portfolio is not only well diversified between sectors, but also between industries and even sub-industries. That way, when the inevitable dividend cut happens, it doesn't affect one's cash flow in a major way. However, an investor who has a higher risk tolerance and therefore doesn't mind a more concentrated portfolio might try to remove the 4% limit in an attempt to boost the portfolio's returns, especially if the company is in the top 5 of that week's ranking, as mentioned in bullet point 1. So far, not limiting stock positions to 4% of the portfolio would have improved annual returns by 28.4%. But again, I personally prefer a more diversified portfolio. Number 3. The under-the-radar dividend-paying companies, despite having some incredible performers like F&G Annuities 119% gain in 12 months, and Repositrax 97% gain in the same time frame, they have, on average, have not performed quite as well as the dividend-growers in the portfolio. So skipping the under-the-radar dividend-payers is an option to try to boost portfolio returns. One possible reason these stocks have not done quite as well as the dividend-growers is because many of the under-the-radar companies are very small companies, and small stocks on average have not performed as well as large stocks in recent years. Like the previous strategies, this method reduces portfolio diversification. Number 4, you could sell when a stock is fairly valued, even if dividend quality metrics are excellent. Now, we do not sell often in the portfolio, definitely not weekly, and tend to only sell if the company cuts a dividend or the stock appears to be overvalued, or the company's dividend quality metrics fall out of the top 50% of stocks. In other words, if a stock appears to be fairly valued, but the dividend quality metrics are good, like they're in the top 50%, we usually will not sell the stock just because it's fairly valued. But if you have your own valuation methodology, and a lot of people do, ours is not the be-all and end-all, and your methodology signals that the stock is fairly valued or even overvalued, you might try selling at that time and reinvesting in that week's top 10 stocks that we are buying. The downside would be higher turnover, but this could boost your portfolio's returns by not holding onto fairly valued stocks. If you try this, I'd be very interested to hear your results. Of course, this 4th strategy is the most difficult to implement because you have to implement your own valuation methodology separate from ours. For those looking for a less hands-on approach, let's talk about some options to potentially simplify things. For our model portfolios, we invest weekly, but there is no hard and set rule that says to do that. Most people invest with every paycheck, meaning that most people have funds taken out of their paycheck, which is usually every other week, and it's automatically invested in their 401k. When I started our dividend growth stock portfolio, I originally invested $25 every other week instead of $12.50 every week. I only switched from every other week to weekly because I found the process to be fun. Now, the advantage of investing every week as opposed to every other week or monthly is you get more diversification. But remember, our dividend growth stock portfolio has around 100 stocks in it, so some people don't want that many. So if one doesn't mind less diversification in their portfolio, option 1 is invest every other week or monthly instead of weekly. Option 2 is to just buy the high quality stocks, meaning those with a quality rating of B- or better, and hold forever. Over time, some stocks will turn out to be clunkers, but they will just become very small parts of your portfolio as you let your winners run. On this slide, we're looking at our stocks that have raised their dividends recently. The holy grail of investing in dividend-paying stocks is to have your portfolio generate enough dividends to cover your annual expenses, a level I've reached despite being on a teacher salary. Now, historically, dividend-paying companies raise their dividends by 5 to 6% per year, which is above the historical rate of inflation. That means a stock portfolio can produce the ultimate passive income stream, that being one that increases each year above the rate of inflation. Now, as I predicted last few videos, Broadcom announced a dividend boost last week. And it's the second time this year that Broadcom has increased the dividend. The latest raise last week was announced Thursday and turns out to be an 11.3% increase. The company has now raised its dividend for the 14th consecutive year. Broadcom also announced its quarterly results last Thursday, reporting that profits increased 23%, revenue increased 51%, and free cash flow increased 16%. And as we'll see later, the stock was up over 25% last week. Other companies in our portfolio announcing dividend increases last week were Pfizer at 2.4%, Bristol Myers at 3.3%, and Eli Lilly with a 15.4% dividend boost. The last 22 dividend increases for the portfolio have an average increase of 9.9%. Now let's talk about stock splits. This slide shows stocks in our portfolios that have chosen to split their stocks. Since we keep track of every individual purchase in Excel, it's important that we have this slide to remind us to go back and adjust the purchase price, shares held, and the dividends per share we received once a stock split has occurred. So we did that with Entergy Corp this week, which split 2-for-1. I should say last week. Here's a look at the 10 stocks that make up the largest portion of the dividend growth portfolio as of Friday after the market closed. Microsoft remains at the top spot with 3 credit card companies filling the next 3 slots, those being American Express, Visa, and MasterCard. Those are awesome dividend growers. Remember, our goal is to build a conservative and diversified portfolio by limiting the amount we invest into one single company. Aggressive investors might not want to limit the investment into any one stock, but I'm a conservative investor, therefore we temporarily stop investing in a company if they make up more than 4% of our portfolio. This leads to a less risky, more diversified portfolio. It's true that our portfolio's return would likely be higher if we always invest in our top 10 stocks, regardless of the size of the stock's portfolio allocation. But that also creates a more concentrated, more volatile portfolio, and many investors cannot psychologically stick with a volatile portfolio. Volatility often causes investors to panic and sell at the worst time possible. Now our portfolio holdings now are at 103, with 80 being the high quality dividend growers and 23 being the under the radar dividend payers. Now we usually make far more additional investments into the dividend growers than the under the radar dividend payer stocks. So if you go by allocation wise, about 90% of our portfolio is in the dividend growers. So far, around 100 to 105 stocks seems to be the natural limit for the portfolio, as there are only so many quality dividend-paying companies that are trading at a discount at any one time. Now, 103 might seem like a large number of companies to keep track of, but the spreadsheet we've developed for tracking the companies make it obvious when to sell a company once we download company financial and accounting information into the spreadsheet, which we do at least weekly and doesn't take much time. What did take a lot of time was creating the spreadsheet. It took about 2 years to create the spreadsheet, and it's a lot of hard work. And the spreadsheet takes a lot of power for your computer, so your computer needs to have a lot of RAM if you're ever going to do something like this on your own. So now let's talk about our high yield dividend paying stock portfolio. I've had several older students who are closer to retirement take my classes. They are more interested in stocks with higher dividend yields and asked to start a portfolio using a strategy featuring stocks with higher yields than the stocks in our dividend growth portfolio. So in August of 2023, we started investing $12.50 each week into stocks with higher dividend payouts. The portfolio as a whole has an annual total return of 28.22%. Since the portfolio has been in existence for nearly 16 months, that return will likely fluctuate a lot more than the return of our dividend growth stock portfolio, which has started 20 months earlier. Currently, the high yield portfolio's dividend yield, if you bought everything now, is 4.26%. But the companies in it likely will not grow their dividends as much as the stocks in our dividend growth stock portfolio. Therefore, this portfolio would be more geared toward investors closer to retirement. Having said that, many stocks in the portfolio have increased their dividends, pushing the portfolio's yield based on the amount we've invested to 5.07%. 2 strategies are being implemented in this portfolio, as you see in the next few slides. Strategy 1 emphasizes a high dividend yield over dividend growth. Strategy 2 also features stocks paying higher dividend yields, but places a bit more emphasis on recent dividend growth than Strategy 1 in an attempt to try to get the best of both worlds, high yield and dividend growth. Strategy 2 has been the better performer so far. The average investment in Strategy 2 has provided a total return of 18.08% and has been held for an average of 193.9 days so far, which is an annualized rate of 36.78% using Excel's rate function. Now, it's not likely the portfolio can keep an annual return that high since the stocks historically average 9 to 10% per year. On this slide, we're looking at the high yield dividend-paying stocks we bought last week. And because the high yield stock portfolio currently has less than 0.5% in tech stocks, for those that want to add diversification of the portfolio, I added to my site a list of technology-focused investments that provide income with yields from less than 2%, like Microsoft, to yields as high as 10 to 12%, all of which I either currently invest in or have invested in. I'll also tell you which is my favorite. Of course, the technology-focused investments with the higher yields don't have the chance to grow their distribution yields as fast as a company like Microsoft or Broadcom. There's always a trade-off, so don't chase yield. One thing that's different about this higher yield strategy versus our dividend growth strategy on the previous slides is we only purchase 8 stocks each week, and we have 2 different strategies within this portfolio. As I mentioned earlier, strategy 1 emphasizes a high dividend yield over dividend growth. It's perfect for investors in retirement or getting close. Strategy 2 still emphasizes high dividend growth, but places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds. Because there are 2 different strategies, we have 4 stocks in strategy 1 and 4 stocks in strategy 2, giving us 2 rankings. So each week we take $12.50 and split it between 8 stocks. So each stock gets a 1/8 weighting. Now, having 2 strategies within one portfolio also means a stock could appear both in strategy 1 and strategy 2, like PepsiCo did last week. Now, both strategies still only invest in high quality stocks, meaning a quality ranking of B- or better. So the 4 high yield stocks we bought last week for implementing strategy 1 in red are Bristol Myers, CVS, United Parcel Service, UPS, and PepsiCo. And the 4 high yield stocks we bought last week while implementing strategy 2 are Microchip, PepsiCo, UPS, and Gilead. Now, Microchip is the first tech stock we've bought for this portfolio. So that's why it only has less than 0.5% in tech stocks, with the tech stocks being Microchip. Last week's purchases had an average yield of 4.1%, with UPS coming at the highest with a 5.2% dividend yield. Here's a look at last Monday's ratings for competitive advantages, management, and financial health. And on this slide, we can see last Monday's grade for recent dividend growth and current yield, as well as recent dividend growth history. And in the last column, you can see the grades for dividend growth potential, which will be much lower than the stocks in our dividend growth portfolio, which consist of stocks with usually lower yields, but a greater potential for excellent future growth in those dividend payouts. And here are our trade confirmations from last Monday for the high yield stock portfolio. We took the weekly deposit plus any dividends that had recently been received, plus the proceeds from the sale of Kinder Morgan, which provided the portfolio with a 63.6% total return, and then invested the total funds in the top 8 stocks on our buy list for the week. All right, we're almost done here. Now let's talk about our 2 technology stock portfolios. Because my students love technology stocks as well as crypto and options, we started 2 technology portfolios just for fun. Now for this first one, on January 1st of this year, I funded a Fidelity account with $1,000, and we invested it into only stocks offering products or services involved around certain technology themes. Unlike our other portfolios, we are not investing additional funds each week into this portfolio. We are sticking with the original $1,000 investment. The tech themes we built the portfolio around so far are artificial intelligence, cloud computing, software as a service, cybersecurity, and big data. This portfolio can invest in sectors outside of the technology sector as long as the company is connected to one or more of our tech themes. For example, both Meta Platforms and Google are in the portfolio, but they are in the communications sector, not the technology sector. So far, the portfolio has gained 43.45% in a little less than 12 months. In comparison, technology ETF with the ticker symbol XLK is up 24.8%, and the S&P 500 is up 28.3%. So far, the best performers in the portfolio are NVIDIA at 194%, Broadcom, Pure Storage, Meta, SAP, Fortinet, and ServiceNow. And let's talk about our tech stock portfolio that we invest each week in. Back in late April, we started a portfolio that only invests in stocks that are officially in the technology sector. Like the other portfolios, we invest $12.50 each week into it and then boost that investment annually by the rate of inflation. Because it's less than a year, that since we only started in April, we've not boosted it. We will boost the investment amount in January by the rate of inflation. Anyway, so I hesitate to call this a portfolio since it's limited to only one sector, but it's been very fun and chaotic to follow. It's very volatile. Since this portfolio started, it has outperformed the two dividend portfolios over the same period. After 2 crazy good weeks, tech stocks took a breather last week. This portfolio has been very volatile, like I mentioned, once again showing the advantage of lower volatility strategies, such as dividend investing, for those that can't stomach such large swings up and down. Now, some people can handle the volatile swings, so just make sure you pick an investment strategy that you are comfortable with. So how is this portfolio different from the $1,000 tech portfolio shown on the previous slide? The portfolio on the previous slide is based on certain technology themes and therefore includes some stocks that are not technically in the technology sector, like Google and Amazon. So on this slide, I rate the top stocks for the week, but they must be in the technology sector. The average investment so far has been held for 109 days and has produced an average total return of 15.09%. Using Excel's rate function, that's a 59.55% annualized return. If we'd instead invested our weekly investment into one of the largest technology ETFs called XLK, instead of a 15.09% average return, we would get an average return of 7.71% with the same average holding period, which is 26.7% annualized. The portfolio is also outperforming the S&P 500, but remember, this tech portfolio is very volatile, so it's not for the faint of heart. Note that all these stocks are higher quality, meaning they must have a quality ranking of B- or better. Also note that the ranking system used for these tech stocks may differ from the rankings we use to rate dividend growth stocks, because many tech stocks do not pay dividends, even though about 80% of the ones in this portfolio do pay dividends. Therefore, in this ranking, we ignore the criteria that involves dividend growth, dividend payout ratio, etc., but we use a valuation methodology we discuss in class that can be used on all large stocks, whether they pay a dividend or not. So the top 4 tech stocks in our ranking last week were Lam Research, Applied Materials, NICE, and KLA Tencor. So of these companies, the ones that do not pay a dividend are NICE, Synopsys. I think that's the only 2. So about 80% on average do pay a dividend. All right. So in the comments, let me know if you have any questions, and also let me know what other kind of investing videos you'd like to see. Also, if you're a subscriber to my newsletter, to my website, and you'd like to see the tech stock portfolio added to our website, let me know. And finally, here are the places you can reach me: YouTube, obviously, as well as my website, beatthestockmarket.com, LinkedIn, and Twitter. Remember, you can now find both the dividend growth stock portfolio and the high yield stock portfolio on our website, beatthestockmarket.com. And we give real-time transaction data on Mondays when we make our weekly investments, and anytime we sell a stock, as well as information about all of our portfolio holdings. I'll see you again next week with a list of stocks we'll have purchased on Monday. See ya!